All right, Accounting 1 kids, welcome to Chapter 10, which is going to be talking about two new journals, our sales journal and also our cash receipts journal. So two new ones in addition to our purchases and our cash payments. So today what we're going to look at is the relationship between the accounts receivable ledger, no, receivable, not payable, and its controlling account. And then we're also going to record sales on account using a sales journal. So, what we're focusing on in this chapter is the merchandising business that sells merchandise to receive revenue. So that is what our company does. We sell our merchandise and we receive money in the form of revenue. So we have what's called the selling price, and this is the amount that the business receives from the sale of an item of merchandise. However, we have to remember that the selling price is different than the actual cost of merchandise. So remember that what we learned in the last chapter is that we were buying all of this merchandise, right, our purchases, and we recorded that at cost, what we paid for it. But then we don't sell it for the same price. There's a markup that happens. If we sold it for the same price, we wouldn't be making any money. So remember that a markup is an amount that a business adds to the cost of merchandise in order to get to the selling price. So cost of merchandise is what we bought it for. We add a markup and that gives us our selling price. Okay. So remember that when we make a sale, we had sales before when we were talking about a service business. The same sales apply when we're talking about sales of merchandise. You can either have a sale on account, which means that the people buy from you but they don't pay you, or they can pay you that very day with cash. So regardless of when payment is received, the revenue gets recorded when a sale is made. Remember, that's our accounting concept of the realization of revenue. We record sales when they're made, and we record expenses when they're incurred, not on the date when the cash is actually received. If we did that, that would be something called the cash basis of accounting. And if you remember back from like chapter 2, we do the accrual basis of accounting. So, like most large companies, our business uses a subsidiary ledger for its receivables. So, receivables, remember, are people that have bought on account and haven't paid us. So, just like we did with our accounts payable and our vendors, the people that we bought from and owed money to, we also do the same thing for receivables. So, we have an accounts receivable ledger, which is a subsidiary ledger containing all of the accounts for all of our charge customers or people that buy from us on account. So if we were to total all of those customers up, that's going to equal the balance in that controlling account called accounts receivable. That's the one we've always worked with. Now all we're doing is we're breaking it down and we have individual accounts receivable accounts for all of our different customers. Remember that the reason we do this is we want to have the most accurate, up-to-date records as we can so that we know who owes us money while still maintaining good relationships with all of the people that use us to charge on account. So the same numbering system, this should look very similar. It should look just like it did with the accounts payable. It's just that each one of these now is one of our customers. So people who have bought from us on account and owe us money. So you can see each of these has an amount. And the total of this is 10,498. That's our total that you would see in the accounts receivable ledger. Okay. And again, this is using a 3-digit numbering system. Digit 1 shows that it's in the controlling account. Remember, accounts receivable. Remember, all of our accounts payable started with 2, which means that it's in the liability account. And then the digits 2 and 3 are the unique number that gets assigned to each account. You can see 10, 20, 30, 40, 50. And we use the same file management system that we did, leaving enough room in between numbers to add new accounts if we needed to. So the subsidiary ledger form is going to look almost identical to the accounts payable. It's just that this time notice that it's a debit balance instead of a credit balance. Remember, it's going to be a debit balance because accounts receivable is an asset, which means that its normal balance is a debit. So you're never going to have people that are in a credit balance in an asset here. So they should look almost identical. The only difference is that debit balance there that we just talked about. So the other thing that we have to pay attention to when we're making sales is sales tax. And the laws in each state vary, as well as certain laws in cities regarding the sale of merchandise. and whether tax is collected. You can think, for example, of clothing. Clothing is taxed in North Dakota, but not taxed in Minnesota, and vice versa. So there's lots of different things. We just have to be aware of them. So usually, what we call sales tax is simply a tax on the sale of merchandise or services. And usually it's stated as a percentage of sales. So it would be like 6.25% of whatever your sale is, you're going to pay tax on that. Regardless of what the tax rates are, though, our accounting procedure for recording it is going to be the same. So, when businesses collect sales tax, they have to file special reports with the government and pay the amount of sales tax that gets collected. So every business collecting a sales tax needs to have accurate records for two things. One, they have to have their total sales, because obviously that's what sales tax is based on. And then they also have to have accurate records for how much that sales tax is collected. So since the amount of sales tax collected by a business does not actually go to them, it goes to the government. So sales tax is actually a liability for us until we actually pay it to the government, because we don't get that money. That money goes to the government, so that's a payable for us or a liability. So we have a new account. It's called sales tax payable. It's going to be a separate liability account. Because it's a payable or a liability, it means it has a normal credit balance, so it increases on the credit side and decreases on the debit side. So that brings us to our sales journal. Our sales journal, you can see, is one of our special journals, one of our 4 that we're getting introduced to. And the thing you have to remember about a sales journal, again, is it's recording only sales of merchandise on account. Very, very important. I will say that again. A sales journal only records sales of merchandise on account. If you sell merchandise for cash, it does not go in the sales journal. It's going to go in our cash receipts, which we haven't been introduced to yet. So only sales of merchandise on account. So you're going to see we have 3 special amount columns. We have an accounts receivable debit. Obviously, if we're selling on account, that means that people owe us money. So that's our accounts receivable debit. We've got our sales credit, because if we're selling things, sales are going up with a credit. And then don't forget about our sales tax payable credit, which again is us recording that liability sales tax that we will eventually pay to the government. So when merchandise is sold on account, the seller prepares an invoice to document that sale. So the seller, remember, is us. A sales invoice simply describes the goods or services sold, the quantity, the price, and the terms of the sale. Again, we just have to have something, some sort of evidence that the transaction took place. That's our accounting concept, objective evidence. So sales invoices get used as the source document when we are recording a sale of invoice on account. What we consider a sales invoice for us, the seller, we've talked about purchases invoices before. Those are from our customers. So that's just on the flip side of things. We've already talked about that as being the person buying. It's a purchase invoice, but when we're the ones selling, it's a sales invoice. So here's an example of a sales invoice. Remember, our company is 3 Green Products, so that's why their name is up here. And we're selling to Wells Apartment. We sold them 10 boxes of copy paper and 100-watt incandescent light bulbs. We've got our unit price, the number that they bought, and then the total. Also notice down here that we have our sales tax. We'll also need to pay attention to that when we go ahead and journalize our transaction. So it says on November 4th, we sold merchandise on account to Wells Apartment for $454.50 plus sales tax of $27.27 for a total of $481.77. So when we journalize this, remember that accounts receivable, the amount that they owe us goes up for the total. It goes up for the amount of merchandise they bought as well as the sales tax. So that's the total that goes up for accounts receivable. The sales goes up for just how much we sold in merchandise, which was the $454.50. And then our other credit goes to sales tax payable. So you can see those two together, our 2 credits, equal our debit. And that's what we want to see. So here you can see in our sales journal, we put our date, we put our account that gets debited, which of course is who we sold to, which was Wells Apartment. We put our sales invoice number. Notice that we don't have to put an S for sales invoice because it already says sale number here. Our accounts receivable debit goes in, our sales credit, and our sales tax. Now, when a sale on account transaction happens, remember that this increases an amount that's going to be collected later by a customer, because at this point we have not received any cash. They owe us money. And again, remember we do this because we are doing accrual basis of accounting, which means we record at the time the sale happened, not when the cash is actually received. And the last thing to just think about when we're making sales is that there are some organizations that are exempt from sales taxes. One of those happens to be schools, and a lot of times nonprofit organizations also don't have to pay sales tax. So if this happens, usually the transaction will state it. And in that case, what happens is that the sales credit and the accounts receivable debit column, they get the exact same amount because there is no sales tax and in that transaction. So, we are ready to head over and do our work together on chapter 10-1, so I'll meet you over there.